Would you take out a loan with 400% or higher interest? Well, that's what happens in most states when someone takes out a payday loan. Today we're going to talk about what payday loans are, why you should avoid them, and what are some of your other options. I'm Scott Bell, and this is Real Money, Real People. You've run out of money, you don't get paid for another week, and your car breaks down, or your power bill is due. You need some money right now. What is all too common these days is a trip to a payday lender or a website where you can borrow anywhere from $100 up to $1,000 or more. This may seem okay until you look into the fees and interest rates associated with payday lending. But first, let's talk about what exactly a payday loan is. The United States Consumer Financial Protection Bureau defines a payday loan as a short-term cash loan based on the borrower's personal check held for future deposit or electronic access to the borrower's bank account. In practice, what that means is you give the lender a post-dated check that they will deposit on a certain day after your next payday, unless you pay the loan in full plus finance charges, or you let the check be deposited, or you don't pay and let the loan roll over to the next payday, which of course incurs more fees and more interest. In addition, payday loans are easy to get because the lender doesn't look at your credit before lending you the money. All you typically need in order to borrow the money is a steady source of income, even disability or unemployment, an ID to prove you're 18 or over, and a bank account in good standing that they can go after if you don't pay. This kind of tells you what the payday lender is most interested in. Not your ability to repay the loan, but their ability to collect it from you. That kind of flips more traditional lending on its head and kind of tells you what they think of you as a customer. That's how payday lending works. Let's look at some reasons why you should avoid these loans at all costs. First, the interest rate. Payday lenders usually charge a service fee plus interest on the loan. A typical service fee is $15 to $30 per $100 borrowed, and the average repayment period is 2 weeks. However, the Consumer Financial Protection Bureau found that if the service fees are factored in as interest, the effective average annual interest rate for a payday loan is about 400%. Yes, 400%. In fact, some studies show that with some loans, the effective annual interest rate is 780%. That's insane. Second, the loan can roll over. If you don't repay the loan at the end of the 2-week period, the lender can roll the loan over for another 2 weeks, which can be treated as a new loan, and you get charged new fees for the new loan that covers the old loan. This way, new fees compound on the old fees of the previous loan, and you're paying fees on top of fees on top of fees. The Consumer Financial Protection Bureau found that 80% of borrowers either roll their loans over into new loans or re-borrow from the payday lender within 30 days. Even worse, 20% of payday borrowers wind up taking out, on average, 10 loans in succession, which means once you're in, it's nearly impossible to get out.
It's a trap!
Third, payday loans don't help your credit, even if you pay them on time as agreed. This is because payday lenders don't report your payments to the credit reporting agencies. But if you don't pay, these loans are often sold to collection agencies, who then do report the delinquent account to credit reporting agencies. So what that means is that your credit gets damaged if you don't pay the loan, but your credit doesn't get better if you do pay the loan. Fourth, payday loans allow you to kind of kick your financial can down the road. If you're using payday loans, your financial situation has become dire, and you need to address the issues. The payday loan allows you to put a band-aid on your money problems without actually doing anything to fix what's wrong. The problem with that is if you're not making the situation better, then it's just getting worse. Obviously, payday loans are to be avoided at all costs. So let's look at some alternatives to payday loans. There are two sides of the coin to look at when you're trying to avoid taking out payday loans. 1, your income, and 2, your expenses. Ideally, you'd like to address both your income and your expenses at the same time. But let's look at the income side of the equation first. Short-term income can be obtained from several sources, like can you borrow money from friends or family? Obviously, borrowing from friends or family is a potential minefield, but if your situation is truly temporary, then they may be a good resource to help you get through the rough time. Can you get a small advance on your next paycheck maybe? Or do you have any unused items around the house you can sell on, say, Facebook Marketplace, like an old phone or sporting equipment? Can you start working a rideshare or delivery gig, some kind of side hustle to bring in some extra money quick? Also, food assistance programs can free up money you can use for other expenses. And lastly, emergency cash aid is available in many states to help you fill the gap between what you earn and what you need to live. Now let's look at the expense side of the equation. The idea here is to get your expenses down so that you have money to get you by. You can start by asking your landlord to accept partial rent and maybe offer to get caught up next month or spread it out over a few months. Next, call your creditors to ask for an extension or lowered interest rates. Some creditors are willing to work with you and keep you as a customer instead of not working with you and having to sue you to try to collect or charge off the debt and sell it to a collection agency, especially now during these pandemic times. You can also take out a debt consolidation loan at a lower interest rate through a more traditional lender in order to lower your monthly debt payments. One online option here is Upstart.com. Now they're not sponsoring me or anything, but they are one of the better loan consolidation lenders out there. If you do this, make sure your interest rate and payment as a result is lower than what you're already paying and that there is no prepayment penalty in case you're able to pay off the consolidation loan early. Ultimately, the key here is that your situation is truly temporary. Maybe you have a 1-month shortfall due to some unforeseen expense. This is the ideal situation. But if your need for cash is not directly related to a one-time or temporary problem, then you have to face the fact that you may be living above your means, or that even more drastic measures need to be taken. If that's the case, you need to start with the short-term steps I talked about already and combine those with more long-term solutions. The goal here is to plug the hole in your sinking financial boat immediately while having a plan to make fundamental long-term changes. The first of those fundamental long-term changes is to make a budget. I know I harp on this a lot and almost no one does it, but it's always the first step to changing your long-term financial future. You simply have to know where you're starting from in order to come up with a plan to get you where you want to go. Plus, comparing a budget with what you're actually spending your money on takes us to the second step. Cut out unnecessary expenses. Oftentimes, people who are struggling financially just aren't aware of where their money is going, and using a budget to analyze their actual spending will tell them exactly what expenses to focus on. How much are you spending at Starbucks, for example, or eating out? How many streaming services are you spending $10 a month on that you don't really need right now? The average American spends $39 per month just on streaming services. Look for these little expenses and cut them out, and they'll add up. If you have the luxury of time, you can definitely look into increasing your income through obtaining monetizable skills or turn your time into money with a side hustle. But if you don't have time, definitely look into credit counseling or even bankruptcy to get you a fresh start. But no matter what, there are always options. And the last option you ever want to consider would be a short-term or payday loan. Just don't do it, and you'll be better off. If you found this helpful, please remember to like and subscribe below. It really helps the channel and allows me to put out more information. Thanks for stopping by. Real Money, Real People.